everybody. It is Wednesday, November 9th, 2022. I am your host, Justin Bogard. My company is Bright Path Notes, and we are the sponsor here for the meetup. This is the Real Estate Note Investing Be the Bank meetup, and it has to call it a broadcast. I shouldn't say meetup anymore. Today, we're going to be talking about some conferences that Richard and I have gone to recently and discuss kind of what we learned from them. Also, we'll have kind of a case study towards the end of the presentation today, and also bring you some up-to-date information as it pertains to the mortgage industry. So stay tuned. You don't want to miss this. Hey, Richard.
Hey.
It's Wednesday,
Yeah.
one day after Election Day.
Yeah, I think all of our fans out there should know, you know what's coming, should know that you will not let me dance to this zippy music before it comes on the show. Even though my significant other says, you're not going to take those moves to the dance floor, are you? No.
Keep those in your pocket. Save them for a rainy day.
All right.
Maybe someday when the cameras are off and we're not recording.
You are no fun, dude. No fun.
All right, man. Well, we've had quite an adventure the last couple of weeks with some conferences going up. So I feel like we've, just gotten a lot out of our system by going to some conferences. So we're going to be talking about that in a little bit. Mm-hmm. But as far as what's going on in the industry, we're going to be talking a little bit about the mortgage monitor update as Black Knight Financial Data brings out. And I got a little case study. I don't think I've actually shown you this case study. It's not a full case study from like beginning to end. It's more of we're in the process of underwriting and closing a loan. And I thought it was kind of interesting how this plays out and what we can do to kind of fix it. So we can kind of talk about that a little bit. But I'm going to go ahead and bring up the PowerPoint, Richard. And like I said before offline, I'm kind of using my laptop today. Right. So things might be off a little bit. So I'll do my best to kind of squeeze the stuff over here.
You want to talk about Cyrea or sponsors or anybody like that?
We're going to do that during the presentation. So let me pull up the PowerPoint so we can do that. Hang in there. Let me switch this over.
This is radical.
Here's something else today. Here's something else. All right. All right. How's that look?
That looks great. This is Radical Radio.
This is Radical Radio. Radical man, Radical man. All right. This wouldn't be possible without some sponsorship. So my company, Bright Path Notes, we have a note deals. And you're going to find out a little bit about that a little bit later today. We actually have some loans that we're going to release to you guys that watch our broadcast here and a part of our Facebook group. And you're going to provide us your email information, and we'll tell you how to do that later on in the broadcast today. So we've got the deal flow to make your cash flow. A local Cyrea company, actually, it's a real estate association, CIREA, and they are a part of our local community care, and they have a lot of Indianapolis-focused real estate investors, from landlording to fix and flipping to wholesalers. Know people like myself, Airbnb, short-term, things like that. They're all a part of this community, and it's great for education. And if you invest in the Midwest and this area, it's good to know this group and be a part of it, because they can be your boots on the ground and help you offload and possibly purchase inventory as well. So you can check out the executive director there. There's also a group of us that is called the subgroup for notes. And that is the group that comes part of this broadcast as well. We also have a note investing training program. It's called Constant Cash Flow. And you can find out more information if you email info@brightpathnotes.com. So you can get the Constant Cash Flow training program. It's usually a few $100. It's got about 25 plus videos that we have. Richard, myself, Larry, our friends Larry and Mariska out in Idaho now. They are also teachers in this as well. So you're going to see all of us and talk about the basics and the fundamental of notes. So we highly recommend you getting into that if you are first starting into notes.
I
And
had
we
a
can't-
couple
Go ahead.
people pull me aside at the Note Expo last week, and they said they were taking it and enjoying it. And so
Oh, good.
Yeah.
Yeah, it's always good to get some nice feedback. That's
Mhm.
great. So let's not forget our other sponsor. It is the self-directed IRA company called NewView Trust. You can email new accounts at newviewira.com and mention this broadcast. They will waive your setup fee. How about that?
Mhm.
All right, this is just for the Cyria members here. So you want to take out your little camera on your smartphone. My smartphone is right here. And you're going to hover over that QR code. If you hover long enough, it's going to know that that's a link, and you tap on the link on your phone, and then you can enter in your PHP information to get your PHP credits, which I believe is just your first name, your last name, and your email address. And you get credits for being a part of this broadcast, and it goes towards something in the future.
What does PHP stand for?
Every time somebody asks me that, and I just don't know.
Pretty
I think
hot
it's
property?
something housing partnership, I think.
Okay. I like Pretty Hot Property better.
Pretty hot property.
Yeah,
All right.
yeah.
So Be the Bank is the podcast that we do, and Richard is on most of the time as well. And that's an audio only. We do record the video of it as well. And you can look at that on the Bright Path Notes YouTube channel. And you can download this on all the podcast directories. Let's see, Richard, we have on season 4 now, and we have done 22 or 23 episodes. We're going to be getting up to 26 by the end of the year.
Oh my God.
So Richard and I are actually going to record an episode after this broadcast today. How about that?
Mm.
All right. So I went to the Coeur d'Alene CDA REI Summit, is what they call it. Larry and Mariska actually put this together. They did a fantastic job. It was really cool. It's really well done. They had 100+ investors that went here. It was, like I said, it was in Coeur d'Alene. So we had people around Coeur d'Alene and North Idaho. We had people from Spokane, Washington, and Seattle come over. There was a lot of speakers there, Richard. There was probably 15 speakers there. I happened to be on a panel, and I had a little session where I talked about highly marketable seller finance notes. I was trying to reach an audience that are kind of mortgage brokers and wholesalers and fix and flippers, and kind of show them the right ways and the compliant ways to do seller finance paper. And as you can see, there is a little sewer that I thought was kind of cool how they stamped that, the sewer. I'm not sure if they do them all like that in Coeur d'Alene, but it was just kind of neat. And there's that golf course that has the floating green. It actually has cables that run underwater and can pull the green towards you, or they can move it left and right and back out, depending on how they want to change the distance for that particular hole. I think it's hole 14, I believe.
Do they do that after you hit the ball so you can get it closer to the hole?
They give you 2 tries.
There's
So
2
you
tries,
hit,
okay.
you get 2 tries to get it to land it on the green or in the sand there, wherever, somewhere on that island.
Okay.
After the second try, they take you in the little boat, and they get you over there to that little docking station. They walk you up to the green, and then you take your relief shot. There's a designated area. I don't know where it's at on the screen as we're looking at it here. It's where you can take your third shot from there. Hit it in the water. So they do have a driving range that's to the left of this picture, and you can see a little bit of the part in the water on the middle left of your picture there, and that's the driving range where they have these golf balls that are floating golf balls. Hit into the water out there, and then they just collect the golf balls because they come up to the surface, and so that's pretty neat. So that's pretty cool. I went into the gift shop there, just in awe about that floating green. It's the only floating green in the world. So they have island greens that you can hit too in golf, but this is the only floating one, meaning they can actually manipulate and maneuver this island to a certain place if they want to.
I've never heard of such a thing.
Yeah, pretty wild, huh? So here I am talking at the event. You see Larry on the right there. Sorry, the picture's kind of fuzzy. I actually kind of scraped this from somebody on Facebook. I think it was Bob Zackermeyer's wife or someone that was there that took the picture. But Bob Zackermeyer's on my left, your screen right, and then Jeff Watson is on my right, your screen left there. And Jeff Watson is an attorney that's pretty well known in our industry, and he does a lot of self-directed retirement account type of law things. And so he's really good in that space. He's also leads our Seller Finance Coalition, and he goes to Washington and tries to help our lobbyists get our HR 5416. Is that what it is, Richard? I forget the name of the bill. Mm-hmm. But anyways, it's in the House and the Senate, and we're trying to get it through so that we can give more than 3 seller finance transactions in a year without using the underwriter, and that we're trying to go for 24. That's what we're trying to do, so that we can do that for all of our seller financiers. So we were up there on a panel talking about real estate notes and stuff. So that was a pretty fun event. So Larry and Rishka agreed to do that event again for next year. So that would be in September. So those of you on the northwest side of the country or the west side of the country, it's an event that you should go to because they had a lot of good speakers there. A lot of people I'd never seen speak before, and they were high level people, just like Jeff Watson and Bob Zackemeyer. The event that you and I went to, Richard, was Note Expo. And I was on a panel there for our Note School Appreciation Day, which was the one day before the Note Expo. And you can see Mariska is on there on that panel as well. And we were having a good chuckle about something. And so we were talking about our superpowers and our monsters, meaning what are the things that we do really well? And what are the things that we not really fear, but the things that are just a big challenge for us. And so we had about 6 people up there, and we all come from different walks of life, if you will. And we were just kind of talking about that out loud. So I think it got a lot of benefit to the folks in the crowd as well. So that's what we did there. And
you
so
do
Richard,
everything. You do everything well, you know.
Thank you. I appreciate that. So Richard, what was your take from the event?
From the entire event?
Yeah.
Well, I think it's a pretty exciting time overall, and that we're not looking at a tsunami of non-performing notes that are coming to us. It's more of a high tide raises all ships. The performing notes that are non-performing notes that we're starting to see now, and the re-performing notes, actually had nothing to do with the pandemic. They were pre-pandemic, and they were part of the natural flow that they could not foreclose upon during the pandemic due to the forbearance rules. So that's finally starting to roll out. Hedge funds are starting to buy it. Banks are starting to reposition. And right after we get done with that, then the pandemic paper will start to come out. And that's very significant.
Yeah. So Cade Thompson was one of the speakers at Note Expo, and he had discussed about kind of what's going down the pipeline. And Cade Thompson is the CEO of a very big fund, if you will, a hedge fund.
30 billion.
30 billion. Yes, it's just a small one, right? So he spends a lot of money on research and marketing. And so he spent about $2 million this year and was trying to figure out kind of what are the trends and how things are moving forward so they can understand what this slippery slope is going to be like for the next year or two. And so we couldn't begin to explain all the charts and graphs and everything that he had up there to talk about. But the gist of the conversation, and Richard, I'll let you chime in a second to give me your take on it, was that rates are going to go up and rates are going to go down. The question is how much up and how much down? We don't really know, but we can honestly say that with the trends that it's looking at, that they're just going to move up a little and they're going to move back down. They're going to kind of float back and forth for a while. He did talk a lot about what these non-performing loans that are going to be coming around. And so there's a lot of what they call legacy loans, where loans that were having a problem, and they were like non-performing loans before COVID. And then they got stopped during COVID because they couldn't do anything, right, Richard, for about 2 years.
Right.
The counties wouldn't let them be pushed through. So they kind of had to put those on holding patterns. So those loans have gotten pretty far behind and they're pretty delinquent. And those loans are finally starting to trickle out and starting to be pushed out. And so we're going to see a good size push of loans coming through. Like Richard said earlier, there's not going to be a tsunami of loans, but there's definitely going to be a constant supply coming through. And so he was able to speak to that and kind of show us with some data. Richard, I'll go ahead and let you chime in there.
Yeah, no, I think you've summed it up pretty well. I guess I would put a little bit, I tighten the brackets a little bit on what he was saying about rates. Basically, he was saying, I mean, they look at several hundred different indicators nationally. And they're saying that some of the housing markets will lose their values a whole lot faster than others. For instance, San Francisco is going to hold its value. You've got major tech here. You've got 5 universities. Yes, it's going to slump some. But if you take a little town that doesn't have much industry or anything like that, it's going to get hit harder. That's on the price side. On the rate side, I took him to say that rates might go up a half, down a half, up a half, but they're going to modulate all through next year. In other words, we had this recent hike, and we're kind of going to hang there, and that's where they think the Fed needs to be to smooth things out. So actually, that's kind of good if you think about it, because if we have additional spikes, it throws the market into chaos. And things still generally work right now. So that's actually, I think, a rather optimistic prognostication.
Okay. Well, that brings us into some Black Knight financial data here. So as you can see on the screen in front of you, we typically show a couple slides of this stuff, so that Black Knight financial data does a great job of just kind of mining a bunch of data about the mortgages and what's going on. So this is no surprise to Richard and myself about the national delinquency rate. This is any loan that's really missed their payment and has gone more than 90 days, past due. At 2.78% national delinquency rate, it's an extremely low rate. So you can see the average for this time of the year is about 4.66 is what they're calling kind of normal or average. So we're obviously well below that. So current loans and current states of loans as of right now, it's not really a problem, right? We're not having this big fear of people losing, and we're going to talk about some of this data as far as house value and equity and stuff here in just a minute. But there's not this big fear of delinquencies for the current loans that are here right now. The stuff that we're kind of alluding to and talking about coming out of the pipeline is stuff that's been the pre-COVID stuff, and during COVID, some of that stuff is going to be pushed through. So, Richard, are you surprised by this graph?
I am, frankly. I would think that the delinquency rate would be much higher. I think what this reflects somewhat is the fact that we did have mortgage assistance payments programs, and that helped. And also the fact that we have such a high employment rate that a lot of people have been able to get back on their feet.
Yeah.
And they're not delinquent.
Yeah. So this is good. So that's a good sign as far as the health of our current mortgages right now. Mm-hmm. Another slide that I thought was interesting, Richard, is we've talked about this once or twice before, and it's the payment to income ratio versus the 30-year rate. So this graph may look kind of confusing at first, but the dark blue line represents the payment to income ratio, meaning how much of your monthly income does it take to pay for the median price house based on median priced income. And that's the percentage they come up with. So they're saying that 38.9% of median income for a median priced house, that's what it takes to pay your mortgage payment every month. Mm-hmm. It's pretty steep.
And that's too much because, as you know, underwriting standard is 33%. Mm-hmm. So that means that they're eliminating 5.9% of the market.
Right. So that becomes an affordability problem. So you can see the interest rate as it was shown in this graph of 6.9. We know the interest rates have been a little bit higher, a little bit different today in the past few weeks. This data is only taken through September. So it's right there at the end of September is when it kind of stops. So all of October hasn't been accounted for this. That's why you see that number to be 6.9%. So it could be next month when we do this mortgage monitor update, the payment ratio might be higher.
Right. And this is a good additional way of showing people when we say that a lot of people have lost 25 to 40% of their buying power due to the increase in rates. This is another way of showing it.
Mm-hmm. Affordability. Take a look at this graph, Richard. We got most affordable on top and least affordable on the bottom. I'm sure you'll recognize some of those areas on the bottom because they might be down the street from you.
just down the street, yes.
Those of you that don't know, Richard lives in Petaluma, which is pretty close. Are you closest to San Francisco?
Yes.
Okay. Closest to San Francisco. So payment income ratio, you can see is one column. The next column is the payment to income average from 95 to 2003. And then they see that little delta, that difference is at the end there. So let's take it from the top here. So St. Louis and Detroit, Michigan, they seem to be the most affordable markets because they're obviously ranked 1 and 2. And they haven't changed a whole lot from 95, 2003 to now. So I think that number is pretty sustainable. So that seems like a good payment to income ratio. So you mentioned 33% for underwriting. So it looks like once you get past the top 10 markets, maybe 15 to 20, you probably start encroaching on that 33%.
Mm-hmm. Mm-hmm.
And the least affordable markets, you can see at the bottom here, a lot of Californias, Seattle, Washington, so West Coast. And you obviously have Newark, and then Newark, New Jersey area, Miami, Florida. And then that's the only 2 outliers that are east. And then you got Las Vegas and then everything on the west in California.
Right. So those are predominantly California. And what that is reflecting is the stratospheric rise in housing prices that we've experienced out here. And this is another good way of just saying, hey, people are being priced out of the market.
Right. So those that can afford the home obviously are going to be able to get the home, but there's a lot of people that won't be able to afford the home because the mortgage interest rate is so high. We've lost that buying power, as Richard was saying.
Right. And so how do you resolve that? Well, one way is that you walk in with a huge down payment.
Right.
I'm seeing in my neighborhood here, it just kind of amazes me because we are an older neighborhood, older being most of the houses were built from 1860 to 1920. And a lot of people are buying them all cash. And these are not cheap houses at all. And so you say, basically, where are people getting all this cash? Are they cashing in retirement funds? I don't know, but it's the only way they can make the numbers work.
You think they're selling their house and then they're using that cash to buy another house, but a much smaller house?
Yes, to a degree, but I guess that's part of my point is that a lot of the houses here are 4 and 5 bedroom houses. So they're not what you call small. They're great big old Victorians, like a lot of those that were built. So it's just interesting to me. It's saying that people are taking a lot of equity, moving it out of their previous homes.
Yeah.
But there's a gap there. There's a gap between what you'd have to pay for a lot of this house. As you can see right here from these charts, there's a huge gap between what people can pull out of a previous house and put into a new house.
That Los Angeles one is just ridiculous, isn't it? Payment to income ratio. Now, this is based off of the median income versus the median priced house. That's kind of what they're looking at there, but that's very interesting.
Right. And so look at it between 1995 and 2003 and look at it now. I mean, it was at 35% and now it's at 76. Holy smokes. That's
a big jump. 41.1% difference. Because that's what the chart says.
You did that in your head, I bet.
I did. I don't need the chart.
You're smart that way.
I need a chart. This one I thought was pretty interesting. So I wish I had time to paint a better picture of an analogy of what was going on here. So this is green is pandemic start, February 2020 to the peak of real estate home pricing growing. Okay. And then the blue is pandemic start to current state, which is the entire ending month of September. Okay. So what you're looking at is at the bottom of this, at the bottom axis of this graph, it's showing you cities and states at the bottom and certain markets that you would recognize. So Indianapolis, Indiana is actually one of them on there. And you'll notice San Jose, California at the beginning. And you notice Austin, Texas at the very end. So the markets that popped really hard in green here, you'll notice they've deflated back kind of normal. So if you look at this graph and you just ran your finger across this imaginary, everything was like a Nerf column there, you kind of just feel it gradually just kind of going up right there, just on the blue right there. And the green, you notice it popped up real high and then it came back down. So all those housing markets that just went boom crazy, those people that sold their house, well, congratulations. You had a lot of equity just handed to you instantly. And so you made out pretty well. For those that stayed in their house, they saw a big rise, and maybe they took out a home equity line of credit. And guess what? The values came down pretty sharply in some of those areas. We're going to look at, let's see, San Diego, California, Seattle, Washington, Sacramento, California, Austin, Texas, obviously, Tampa, Florida, Phoenix, Arizona. If you remember, a lot of experts were saying how those markets were really ballooned or really inflated. And so this is what happens. They came back down. So they didn't lose their, potential rhythm of going up, how they typically grow year after year. They just went up really quick and just came back down to where the normal line is. Does that make sense, Richard?
It does, but what's not computing to me is if I look at San Francisco, this chart seems to be saying that there was a price spike, but that has come back down. But we haven't really lost any value of houses here at all. It's negligible.
Where is it? Help me find out.
San Francisco is the second from the left.
Okay, there we go. Yeah. So it does show that, doesn't it?
Yeah.
So I wonder what that's taking into consideration of where the peak was. And are there certain parts of San Francisco that really didn't get affected by the price hike, or is it just high-end areas?
I don't know. Yeah, this chart is confusing to me. We'd have to look at this a little bit better.
Charts don't lie. Okay. Charts don't lie. The data's in front of you, doesn't lie.
Okay.
I'm just messing with you, but I thought that was interesting. So I just look at it from a different lens and just see how things have. I imagine a balloon, Richard's really big, and then it just came back down to normal size. So a regular balloon, right? If you blow it up right before it pops, it didn't pop. It came back down. Everyone talks about a real estate bust, right? The balloon popping. We got to the point to where it almost popped, and then it just came back down to a normal size inflated balloon.
Okay. Yeah. So the green is a pandemic start to the peak. So that's just, you're at the bottom of the mountain and you went to the top, and here's how high it got.
Yep.
And the blue is, here's what it was from the start to current date. So the blue is the average number, and the green is showing us where the top was. So actually this chart makes sense now to me.
Yeah.
All right.
Yep. Cool. All right, so our next slide here. Okay. So we have this performing loan that we are in contract to buy. It's in Cincy, Ohio, which Cincinnati. I didn't want to spell it out. Obviously, I probably would have misspelled the word, Richard, so I didn't want to spell it all the way out and look like a fool.
Do people say Cincy?
Yeah. People around Cincinnati say Cincy, yeah.
Okay, because you can always tell somebody who's not from San Francisco because they'll say Frisco, and that is just taboo. You do not.
Tomato.
You can just turn around and go back to wherever you came from. Thank you.
Caribbean. Yep.
Yeah,
I get it. So we have a seller, and they have a land contract that they want to sell. Okay, there's a couple problems here with it. So I find out
a couple problems.
Yeah. So I find out the seller of this land contract, the one who created the land contract, had actually bought the property via a sub-2 deal in a property trust. So let's wrap our head around that real quick. So somebody, Sally, here we go. Sally has a house with a mortgage on it, and Sally sells it to Mr. Lender. Mr. Lender says, "Hey, guess what? I don't want to pay you the entire lump sum in cash for this house. I'd like to take over your existing financing because the rate is so good, like like a 2 or 3% rate. And I would like to also give you a little bit of cash on top of that, so I would meet your purchase price because, Sally, if I just paid you all cash, you would just pay off that loan and you don't really get all that money anyway. So why don't you just help me out?" She's like, "Okay." So he takes the property subject to the mortgage. So now it's in Sally's name, the mortgage is, but Mr. Lender is the one that's paying on the mortgage. So hopefully that was a clear understanding of the sub-2 right there.
Right.
So when you take over, and we're not going to have a big lesson on this, we're just going to skim through this part first. So when you have a subject to deal and you take over the mortgage and you're making the payments, but it's not in your name, there is a power of sale clause built into these mortgages to where if the deed changes hands, that triggers the bank to say, nope, the loan is called due 100% and you need to call it due right now or you're in default. In order to skate around that, people will put the properties, when they do these subject twos, into a trust. And then the beneficiary of that trust is the individual. Typically, that is the person that the property, they sold the property from. So it might have been Sally, it might have been somebody else. But that's how they get around it, because there's an act called the St. Germain Act that allows this to happen. There's a special mechanism this way. So like I said, we're not going to get into the mechanics of it. So if you ask a question about it, I'm sorry, we're not going to get into all of it because it can get rather confusing. But basically, he got a subject to and he bought it in a trust, and he sheltered himself from triggering this due on sale clause so that he could buy it and now he can rent it out, or he could buy it and he could resell or finance it, which is what he did in a land contract. And why did he do a land contract? Again, he didn't want to trigger a due on sale clause. So on a land contract, he stays on the deed, or someone stays on the deed, and then the borrower's just gaining equitable title each time they make a payment because it's an installment sale. So hopefully that didn't confuse everybody. But basically, he wrapped that land contract around that mortgage, and that's what Richard and I are trying to purchase.
So Sally slid Cincy. No, Sally slid the seller Cincy, since she wanted to. I could make that go on and on, but I won't.
Yes, you can. I know that you can.
Yeah.
So the land contract wasn't notarized, nor was it recorded. Now, it doesn't surprise me if it wasn't recorded. It's not the end of the world. I typically do record the land contracts, but the fact that it wasn't notarized was just kind of odd. The contract was created, and then it looked like they used DocuSign or something to have the borrower sign it. And there was no DocuSign type of stamp. It's almost like they did a digital signature with no digital proof or digital verification. So that kind of pulls up a red flag right there. And so I showed Richard this. Actually, I don't know if I actually showed you the document, but I told you about it.
No, I saw it. I'm remembering it now. It was sketchy. It was sketchy.
Yeah. So the first thing, your radar goes up. Okay, they're using a trust. They bought it sub 2. They wrapped a land contract around it. This thing wasn't notarized, but it was signed, nor was it recorded. Now, why am I getting hung up on the notarization? Well, right now it's just a piece of paper with a digital signature on it. There's no way to prove that somebody actually signed it. Somebody could have forged the borrower's handwriting in digital format and just put it on there. So there's no way to verify that borrower actually signed that. Right. So that was a problem for me. So I said, okay, I looked at the numbers. We'll talk about that right now. So the sales price was $103,000. The down payment was $3,000. So it wasn't a big down payment. So the loan's actually for $100,000. The rate is just under 9%. You can see that it's $791 monthly payment for a 360-month term. So it's a long note. It's got a decent interest rate for that high of an unpaid balance. And so the P&I was pretty good. What I liked about this loan is that the borrower had been in there for a while and they paid really well. So that's why I didn't look at the down payment as being that was a bad factor about this, but the pay history was so strong that it offset that factor and made it more palatable for us to buy. So that makes sense. So those of you I know that we always harp about getting large down payments. This is one reason why the deal was nice for us, is because we saw the pay history and it was extremely strong.
How many months did we have?
I think there was 15 months paid on it.
Oh, okay.
So the current unpaid balance now is about 99 and some change. So it's, like I said, 15 payments, about 15 payments. And so, like I said, the redeeming factors about this were the fact that I'm going to control this closing, right? So I liked the pay history on it, and that's one of the most important factors about a loan. And the rest of it I can kind of fix now, right, Richard? Because before I close on it, I can set stipulations. So that's why I took the thing off there. So I said, nope, we're going to convert this to a note mortgage. All right. So that means we're going to cancel the land contract. We're going to use a title company. We're going to pay off that underlying lien and wipe that out to make sure that we're truly on as the sole lien holder. You're going to get an owner's title policy and transfer it to the borrowers. And you're going to get a lender's title policy, and that'll be transferable to me to guarantee we're in the first position. Seller's going to pay all the closing costs for this. And the borrowers had the flawless pay history for 12 plus months. And so now we took it from just having a strong pay history to, okay, now we got strong pay history. We've got title insurance. We've got lender insurance. We've gotten rid of the land contract. We've converted to a note mortgage, and the underlying lien is wiped off. So now we're just a true lien on the property. So now it becomes a really strong deal for us. And so this is why we kind of sunk our teeth in here to figure out how can we make this deal more appealing to us or to someone that we might want to sell it to.
Right. So to diverge just for a second, as you know, I went to a private lender conference first part of this week. I did Note Expo last week and a private lender conference this week. And I spoke with 3 different Canadian lenders. They came down and they wanted to see what was going on in the private lending market in the US. And we were talking about home mortgages. You can get a 30-year AM in a home mortgage there.
Yeah.
But it's only got a 5-year term on it. So everybody has to redo their mortgage every 5 years. The point that's most interesting that they made, though, is I said, well, how do you do that? You have to relook at credit score. Do you re-underwrite it every year? And they said, no, we don't bother. As long as they've got a good payment history, that's all we care about. And that's what we say in our private mortgage note market all the time. We're looking at payment history. And you've got 3 Canadian bankers saying the exact same thing, which you would never hear in an American bank.
Right. That's interesting. So this was a one-day event that you went to?
Yeah, it was about 1,000 different participants, both lenders from all over the country and brokers and some borrowers, some note buyers, some note sellers. The note buyers and sellers there bought and sold in bulk. So the minimum package size was 5 million. But
5 million or billion?
5 million. So it's small. I mean, by hedge fund, it was small. But these are private investors like we would get. So somebody with a private fund like us would go out and buy a $5 million package and do whatever they're going to do with it. So it was interesting.
Cool. Very cool. Well, that was kind of our case study there. So we have loans, all types of loans, right, that we buy. And so we finally have put together a small little package for you guys to purchase. So we have first lien residential on single family dwellings performing loans. And they're all really strong performing loans. And they're all set up with loan servicers, and they're all done in this manner at which if there was a problem with it before we bought it, we kind of packaged it up and fixed it, and then made sure it was performing and all good before we want to release it to you guys. So like I said, we got 6 of them. And if you're on the Facebook group, if you're a member of the Facebook group that we have for the Real Estate Note Investing Be the Bank broadcast here, you would have seen that I already posted that, hey, if you give us your email address, we are going to send this tape out to you. So you're the first ones to see it before we publicly offer this on other platforms. And so, like I said, there's going to be 6 loans, and they're all ranging from $22,000 to $90,000 in loan value. As far as loan purchase price, I mean, the loan values are going to be a little bit higher than that. And if you send me your email to info@brightpathnotes.com, and in the subject, just put 6 loan tape, I'll go ahead and send you that tape so you can see it, and you can bid on it if you want. And for the next couple of days, so that we're recording this on a Wednesday, so we're going to do this after tonight's broadcast is complete. And then the next few days, if people send me their contact information, I'll send it to you, have you a chance to bid on it before we start offering it to the public next week. So if there's something that you like on there and you're serious about buying it, by all means, you can have at it, and we'll give you the collateral files, and we'll give you the data tape that has all the terms of the loan on there, and so you can see each of them.
Get it while it's hot, baby.
Get it while it's hot, baby. So email info@brightpathnotes.com so that you can be a part of that. And I'm actually going to put that in our chat box, Richard, so that folks can see that.
Crowd's kind of quiet today.
Yes. We have, the election day was yesterday, so probably people are still
hungover,
doing coming down from that high, right?
Mm.
All right. Comment there. Hopefully that'll
Mhm.
post to everyone that's watching from everywhere across the world. That's okay. Typically, we get a lot more replays, so hopefully people see this tonight or tomorrow, and we'll jump on that opportunity. So, Richard, let me get back to the task at hand here. So, yeah, these are all first lien residential, strong pay history. You get a data tape. You get a link to the collateral file. Price ranges from 22 to 90K as far as purchase price. All these homes are valued much more than what the loan is and is subject to, say, 6 loan tape, and email at info@brightpathnotes.com.
Mm-hmm.
Now send us your deals. We want to see your deals. Doesn't matter if it's land contract, it can be a contract for deed, a note and mortgage, a note and deed of trust, a lease option, as long as it's the first lien. That's what we want to see. So take your smartphone. If you are watching this on a replay, you can pause it and you can hover over that QR code and you can get into our form to submit deals. We've had several people submit deals through here so far. It's been great. And so we really enjoy that process, and it makes it real easy and streamlined for everyone. So send us your deals.
Mm-hmm.
And then the next time we have our broadcast will be December 14th from 6 to 8 p.m. on Wednesday. It happens to be the second Wednesday of the month. I better double check that, but I think it's right. December 14th.
Check it.
Follow us on social media at Bright Path Notes, Facebook, Twitter, and Instagram. And you can look up Richard and I on LinkedIn. We're both on LinkedIn as well. My contact info is justin@brightpathnotes.com, and Richard's is richard@amnotecap.com.
Mm-hmm.
Join our Facebook group. This is what I was talking about before. If you're part of that group, you're in the know first. And it's called Be the Bank, in quotes. Here's my air quotes here. Real estate note investing. And it's got that little logo in the background, and that's how you know you're in the right place.
Right. December 14th is, in fact, the second Wednesday.
Yes.
My question is, are we going to do one from Vietnam in January?
Is that when you're going to Vietnam?
It is.
Well, we are going to do one. It depends on your internet connection, I guess. And I don't know how many hours they're ahead of us, but
15.
15 hours ahead. Oh, wow.
15 for me in California, 12 for you there. But I can handle it.
You can handle it? All right. Well, as long as you have a fast internet connection, I don't think there'll be any issues with that at all.
All right. I'll bring some little trinkets along, and stuff like that to show people.
All right. We're going to transition to our next segment as I pull the PowerPoint off of the screen. Hang tight.
Mm-hmm.
All right, Mr. Richard. I don't have any comments on the board today. I want to check them out as well. Just my comments. Oh, look, there's a comment there. Oh, there's a comment there. This is my comment.
Let's go through the list I sent you a little bit. I don't have it up, but of just topics. I mean, because I thought those were very good. I thought the Cade Thompson topic about interest rates staying relatively high but relatively flat was a very good one. I also thought that it was of note that I went to this mortgage banking conference, as I mentioned to you, and they had a lot of guys up on the stage pontificating about where rates were going to go, and it was very clear that they didn't know what the heck they were talking about. I mean, it was all.
I have a crystal ball, and I know what's going to happen next.
Yeah, it was all anecdotal data, and I thought, really, guys? I mean, you got somebody like Thompson who spends $2 million from a gazillion different data sources, and maybe he's wrong, but at least he's going to be closer to right than those guys.
Well, he doesn't really tell you what's going to happen. He say this is the trend that's happening right now as we see it, and it's obviously it can change,
right?
But this is the trend, and this is where the movement's going, and this is what it's saying it's going to happen. He's giving. He's not an economist per se, but he's saying like, this is what this means. And this is what this means. And these two things are happening. And guess what? Something has to change to get them to balance out. And so he's explaining it that way. So he's saying like, this is what it's saying it's going to do, but he's not saying that it's going to happen. He's just saying like, here's the data. And this is why we spend so much money on it. So we are basing our decisions based off of this information. And so
Yeah,
that's what
he's
we're preparing
running
ourselves
his
for.
business based on that. So to me, that says a whole lot right there. If you're running a $30 billion fund and where you're going to invest based on that, that's pretty significant.
Absolutely. Cool. All right, Richard, I don't see anything else on the boards. If you guys have any comments, I should have said this in the beginning. Feel free to type in if you're on YouTube, LinkedIn, Twitter, Facebook, whatever. You can type in there and we'll get your question. Even if you type in after the presentation's over with, we'll still get your comment and stuff and we can respond back to you or save it for the next broadcast we do on December 14th and we can prepare for that as well. So kind of a short one today, Richard. Hopefully we got a lot of impact for all of you out there.
Hope so. Let's see. Was there any other points though that we wanted to bring up with anybody?
I don't have that pulled up in front of me that you mentioned, but if you think of anything else on top of your head, I'd be happy to share it with the audience right now. Otherwise, we can wait until the next time.
Let me pull things off my notes. Let's see. Well, one of the things I thought that was of note is that there's a lot of dry powder out there, meaning there's a lot of people sitting on money. And we've heard this before, but now we're really starting to see it because we've got groups like Cade Thompson, and they are making major allocations. Notes Direct, right? They're buying an $800 million portfolio, and they're going to put it on their website of Reperforming. One thing that I think is very good for the audience to hear is the quality of Reperforming. I think you heard that at the expo. And basically, Reperforming notes, for all those you don't know, is where somebody stopped making payments and is now starting again. Well,
so they've defaulted. They were in a non-performing status at somehow, and now they are reperforming. So they're performing again. So it would seem like you wouldn't like those loans because, like, oh, if they defaulted once, they'll default again. Not necessarily.
Right. So during the recession, those were what I would call hard defaults. I mean, you see a lot of people with a lot of trash houses. They were out of work for years. Life was just very, very tough. And you had low equity in the market. In this instance, you've got very high equity in the market. Mm-hmm. There was still a real need for jobs. Obviously, unemployment is extremely low at this point. So you got a lot of people going back to work. So these are the reperformers are more blips, and also they're for higher quality assets. So I think there's a lot of good reperforming product out there that you and I especially are going to be able to purchase. With our fund, we haven't mentioned to anybody and brought it up, but we are starting a fund, and we would urge anybody to join us in that effort. We'll have probably a 7 or 8% pay rate, and we will be buying both performing and reperforming and a few non-performing notes.
Yeah, great information, Richard. Anything else on the boards? I don't see anything else. So we're getting close to the hour here. So this is good timing to kind of so don't forget to download the Be the Bank podcast. You're going to hear more stuff like this coming up in the next couple of episodes that are going to be released. So we look forward to seeing you guys next time. Do not hesitate to email us if you have any questions, or hit us up through the Facebook group, or make a comment on this video if you have questions or things that you wanted to have explained. We're happy to do that for you guys. So reach out anytime.
So do we have to wear Santa hats and white beards for the next show?
Well, don't spoil it.
Oh, man. All right. All right.
Well, you already got the white hair.
I do. But
if I wear a hat, I can cover my head.
Okay.
All right, guys. We'll see you next time.
Okay.